Hey, everybody, welcome back to the Four Star Today's Market Explained podcast and video series. I'm your host, Brian Castle, and I'm here with my co host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to be here and talk a little bit about the markets.
Those of you who are new, Chris is our Director of Development at Four Star, and he runs everything to do with products, services, helping advisors develop all things portfolio. And he's a native of Cleveland and still loves his Indians, Chris, or Guardians, now they call them.
Guardians, correct.
All right, man, welcome. And I'm Brian Castle, the CEO and CIO of Four Star Wealth. I'm an advisor to philanthropic needs of wealthy investors, CEOs, and insiders. And also, I'm the husband to the amazing Tripti and father to Evan and Quinn. Please, everybody, if you like what we're doing and you like the show, please send a copy of this to your friends. And you can just send that by text, of course. And then also Apple iTunes has a way to rank. If you can give us a 5 out of 5, the rankings really help us. And so we're ranked now in the top 1% of all podcasts in America. We want to keep it that way and keep growing. So today we're going to go over all the aspects of the economy and the market that we're seeing, what we see out there and other little tidbits, then also about the economy. So Chris, why don't we start out? Tell us what's changed since our last episode regarding the markets.
Yep. Number one, I guess, still is domestic equity. So we're still seeing the domestic equities hold strong in the number one position. It actually firmed up. It gained 3 points, so it's strengthened at 324 tally points. Number two is international equity. So it really kind of took more control of that number two position now. It only gained 1 point, so it only gained to 241. But commodities, which was kind of jostling back and forth, now has fully really dropped into that number three position. It lost 11 points since the last podcast. So now it's sitting at 229. So we've really seen commodities take a little bit of a step back, really, and really more formalize themselves into that number three position. In the bottom three asset classes, cash is still holding at 123, -2 from the last podcast. So it's been relatively steady there in the fourth position. Currencies is in the fifth position at 90, and that was unchanged since the last podcast. And fixed income is kind of the other big mover, really. It gained 8 points from the last podcast, so it firmed up to 82 tally points there. So it's getting closer now to actually challenging currencies and maybe coming out of the cellar into that maybe fifth position there. But we'll have to see. And obviously, a lot of that, I think, is due to the presumption of the rate cuts and things coming down the line right now.
Right. So, Chris, interesting trends there. The bond market, which has been terrible because interest rates have been rising and it's been terrible for a couple of years, is starting to perk up a little bit. And that's probably because the Fed's talking about lowering interest rates, right?
Yeah, I mean, you have the Fed looking at lowering interest rates now, and obviously that has impacts on the yield curve, things like that. So if they're going to look at lowering interest rates, do you look at going to a 10, 20, 30-year bond, locking in maybe the 5-6% interest rates? You can get it now before we see these rate cuts. So usually when you have that rate cut, then those bonds become a little bit pricier. What was $100 a par for maybe a 6% bond now appreciates to $110 par. So I think that dynamic's really playing into that fixed income movement. We'll see how it plays out. Obviously, there's a lot of variables and there's a lot of information we haven't gotten yet. The presumption is the Fed is going to cut rates. They've pretty much hinted at that, but you never know until it actually happens.
So then the domestic equities were up, international was up, and commodities generally in a strong economy are not strong. So that was down, and cash was down because people are pulling money out of cash. There's 6 trillion sitting in cash, and that could come out of cash and go into risk-oriented assets. So all those signals from the last episode say the market is pricing in what could be a good, strong financial market and a better economy, because right now, the numbers were negative. We're going to go through that. But they're expecting if the Fed does lower rates, and that will forestall the decline in the economy and hopefully get the economy growing again, right? So that's what all these things we're seeing in the markets are signaling for the future.
Yeah. Yeah. I mean, I think, that's exactly right. I think what they're hoping for is what is termed as a soft landing, right? That they're going to just start easing right now. They've constricted the economy enough to defeat inflation, and then now they're going to start loosening off a little bit, kind of let the market or the economy start growing again, and have it take back off into an upcycle again, which is what they want to do. In reality, obviously, there's a lot of dynamics that are out of their control, and it's really hard to do soft landings. I'd say 9 times out of 10, historically, they don't land, have soft landings. But you never know. And I think a lot of the data that's come out is better than what people initially anticipated. So I think that's what's really fueling some of the hopes that we will have a soft landing, but it still remains to be seen.
Exactly. So to finish up on the markets, so if rates are going down, interest sensitive securities should do well. So banks, utilities, and different groups that were performing in recent markets when interest rates are going up with technology and communications and other areas, healthcare. Now we're going to see different groups outperform. But then, of course, we had a collapse in the market about 2.5 weeks ago before the Fed made their commentary. And so we had two really, really bad days and they came right into the weekend. So then Monday opened up terrible. So it was a terrible Monday, and then markets finally recovered, and then we went back to new highs only last week. So yesterday, when we came back from the Labor Day holiday on the Tuesday, which is the new Monday, because Monday we're off for Labor Day, we had another huge collapse in the market. But now things are stabilizing. They're not going up, but they're not really going down much. And so that's the precursor to a bit of a recovery. So we don't really see a huge downturn developing now, especially because the Fed is going to ease. Right. So we'll see if that we think that's most likely the right scenario, but we'll see how it plays out, Chris.
Yeah, yeah. I mean, I think right now, what's playing out in the market is the rate cuts are coming, so that's kind of on one side of the dynamic there, but then recession fears. So and that kind of plays into that soft landing. Is this the data we're getting that we're already so bad that the Fed's kind of behind the curve? They're cutting too late, and it's going to be too little, too late. And the U.S. market's already going to be kind of falling into a recession. So that's kind of the fear, and we're seeing that volatility play out. Really, I think one of the big signs a lot of people are looking for is the jobs number this week, and really what they're looking at is the Fed going to cut 25 basis points or 0.25% or 50 basis points, which is still on the table as far as the market's considering. So, one thing that could happen, even if the Fed does cut, maybe if they only cut 25 bips, we could see actually a negative reaction in the market because maybe they were pricing in a 50 basis point cut. So,
Right.
it's one of those weird dynamics where even if the right things happen and line up, we could still see that volatility shake out through the markets.
Yeah. And we might be seeing a leadership change in the markets, Chris, because like I said, we're looking for different stock groups to do well with interest rates going down. And then looking at year to date on the financial markets have been nice and positive. But the NASDAQ, which is the technology index, that is actually now underneath the S&P 500 by about a point. And so maybe since they're not performing as well in the near term, we had a sell-off in technology in the first quarter, rally in the second quarter, but now we're having another sell-off in the third quarter relative to the S&P. So maybe we are seeing some leadership changes, and the interest rate environment, lowering interest rates, switching from a tightening of interest rates environment could actually lead that change in the group. So that's what it looks like right now. We'll see how it plays out.
Yep. Yeah, exactly. It'll be interesting to see. September is going to be an interesting month, I think.
Yeah. And then, of course, we just went through the rejiggering of many of the indexes. And so there's all the studies about stocks that are in the index and what they do. The minute they get in the index, they rise because every fund family in America that owns it as an index fund has to buy them. Now there's a whole body of knowledge now about the names that are removed from the index and everyone has to sell them in those funds. And within a month or two, they're really, really cheap. And so there are people creating funds now of former index names that they buy as everyone else is dumping them, and they generally do pretty well. So there's always a lot of interesting strategies that you can employ as we see things come out of the index. Chris, let's look at the economy. What do we see there? What's the latest updates there?
Yeah, so I mean, I think the news we already kind of discussed. I think the biggest news is really the Federal Reserve. This month, the expectation now from their signaling is that they're going to um, cut rates. That's kind of been long awaited. So really, the only question is whether it's 25 or 50 bips. So we have that coming. I think one of the bigger news is though was employers may have added 818,000 fewer jobs in the 12 months ending in March. When we get some of this economic data, jobs numbers, a lot of that's just kind of the initial numbers. And then as more data comes in, they get kind of revised. And obviously, this is a big downward revision. Actually equates to about 178,000 less jobs a month. It equates to 178,000 jobs a month, which is less than what it was before, which is about 246,000 jobs a month. So, big drop off there. So, once again, that has, I think, some of those recession fears feeding in is as we continue forward and the actual numbers trickle in and these get revised. Is the labor market worse? And I think there was the expectation that it was worse. So I think that's why off of this, we didn't see a huge kind of pullback in the market. But I think that's the fear is the underlying the feeling right now is that the labor market is much weaker. And so the fear is that the Fed is too late, and we already are in a recession, and we just haven't the numbers haven't caught up yet. So that'll be interesting to see. Sales of previously owned homes in July rose 1.3% from June. So that's interesting. We're starting to see a little bit of liquidity in the real estate market from that perspective. But on an annual basis, existing home sales were still down 2.5%. So maybe we're just starting to see the beginnings, if you will, of the market starting to turn over now that we have the expectation that the Federal Reserve will cut rates. And on top of that, the national median existing home price in July was $422,600, which was down slightly from June, but still up 4.2% from a year earlier. And that's going to be really interesting to see because usually when you have a tightening, when you have the Fed raising rates like they did, you expect to see real estate prices drop. And we didn't really see that this rate cycle. So if they start to lower rates now, and that frees up more liquidity, could we see home prices once again start to take off and skyrocket? And what does that do? Do we see home prices, the average home price be 500,000, a year from now? Who knows? But it's going to be really interesting to see how that plays out. And then the last little tidbit I have, U.S. consumer confidence actually rose to 103.3 in August. That was up from 101.9 in July. We're still seeing a little bit of positivity out of there, but we're starting to see some pessimism come in, primarily around the labor market. As I said before, I think there's this underlying feeling that even though most of the data we've seen so far has been positive from a labor market perspective, obviously the revision was bad and stuff, but for the most part, it's been good. I think the feeling is that it's not as good as some of the numbers are showing in reality.
Okay. Well, good, Chris. Well, thank you. Those are all good facts. And confidence was down. Now it's coming back, and we are definitely seeing some changes in the economy and slowing of the economy. In addition to those numbers you mentioned, the personal income numbers in the last month were down, and because personal income overall, meaning all the income everyone is making, so some people are being laid off, and so that income goes out. So personal income as an aggregate number is lower, but then credit balances of what people are spending on credit cards is going up. And so that means basically, since people are getting laid off, they're using credit cards to pay a lot of their bills. That won't happen forever, but it will happen for a couple of months as we come into a recessionary period. But that's a sign that we are falling into recession. And the question, of course, is how bad it gets, right? So the market is now right near a high. We had a bad day yesterday, but we're just a few percentage points off the high. So why would the market be high when we're going into a recession? Usually when they signal recession, the stock markets go down. Well, it could be a sign that the stock market doesn't believe we're going to have a bad recession. So there are split views on that. Brian Westbury of First Trust, who's very, very successful for record, he thinks we're going to have a very, very bad recession. There are many economists that think it's going to be a mild recession. And so the Fed is trying to manage that by lowering rates now. And so we'll see how it all plays out. And while everyone might think they know, no one really knows exactly how all these factors will kick in. But if we do have a really bad recession, Chris, we're probably going to see the stock market go back, and start really trending lower, right? It's very likely that that would happen.
Yeah, I mean, I think that's something that definitely will happen. I think the key will be is how how low does it go? How bad is the recession? I think one of the keys that we kind of saw, I mean, we did see this happen in 2022 when they were raising rates, obviously. We saw the stock market down significantly and the bond market. But I think the key will be how deep, if we do get a recession, how deep will the stock market kind of pull back? I think some of this will depend on the reverse carry trade we talked about, which is primarily driven on Japan and the yen US dollar exchange rate. There's a lot of kind of plays that have been going on for a little bit now. So when you have this dynamic shift, things have to unwind and kind of reverse back. So I would expect with that the volatility and the shocks for there to at least be a little bit of pain in the short term if we have a recession.
Well, and despite many Fed watchers who like to complain about how the Fed does, the Fed generally has a pretty good handle on how to handle the economy. They left interest rates high for quite a number of months here, and long after people thought they should have been lowering rates. Well, now they're going to start lowering rates. So the probability is that the Fed is right, and probably an 80% chance that the Fed lowers interest rates maybe once or twice or maybe even 3 times this year, and they get the economy moving a little bit better, knowing that we're falling into a recession. Lower interest rates will create positive things for banks. Right now, the banks have had tight credit spreads, and it's hurt some of the banking industry. So now that'll be better for the banks and all the interest sensitive type companies. It will lay on a slight negative for savers because everybody kind of got used to that 5% in the money market. So now we're going to 4, maybe high 3s or something like that. But that will also then spur some folks to pull money out of money markets and put it into risk assets. So then it could help the financial markets, the stock markets, the real estate markets, and otherwise. Lower rates will also help the real estate markets as mortgage cost will come down. So that certainly would help the real estate market. And it's been a pretty rough real estate market. The prices have been going up because there's no supply. There haven't been many transactions, and it's been very, very slow across the whole real estate industry nationally. There's always pockets of activity, but in aggregate, that's been a slow real estate market. So we'll see how all those things play out. Now, the other scenario, which we mentioned a number of times on the show, the other 20% probability is that maybe the Fed is moving too quick to lower rates. The Fed had said they wanted inflation to get down to 2% before they made a move on interest rates, but they haven't gotten to 2%. They're in the high 2s, low 3s right now. And they may be seeing numbers that are taking it below 2, but they haven't released any of those numbers. But right now, as it stands, the inflation numbers are higher, yet they're still lowering rates. So they're kind of violating what they said they would do, but they may, again, they may see a reason to do that, or maybe they're bowing to political pressure. Certainly when the Fed lowers interest rates right before an election, the Fed is always seen as political. So it's somewhat political, and you can guess for yourself who that might help by lowering rates before an election. But the risk of lowering rates in an environment where inflation is still stubbornly a bit high is that we reignite inflation. The federal government in the recent years has been running deficits. Certainly a pandemic, we ran many trillions of of deficit we added to our national debt. Last couple of years, we've run about $2 trillion in additional deficits in addition to the regular spending of the federal government based on revenue coming in. So it is entirely possible, although not probable, that the Fed reignites inflation. And if that were to happen, then after one or two interest rate declines, then inflation would spike and take off. And then the next moves would be up, not down on interest rates to ward off inflation. And that's exactly what happened in 1979 through 1981, when they thought inflation had been whipped. The old whip inflation now campaign started in the Nixon administration that then ended up whipping inflation mostly, but not completely. And then they ignited it again by lowering rates and putting more money into the economy. So it took a number of years after President Reagan was elected and Paul Volcker was running the Fed to get interest rates back down, get inflation back down. They had to keep interest rates high to do that. So we'll see. We hope that second scenario is wrong. We hope the Fed is right. And then there'll be a good move and keep the American economy going pretty strong. Chris, one interesting thing that's happened since our last episode is that Japan raised their interest rates for the first time in a long time. They went to 0.15, and they had been at zero interest rates and had been at negative interest rates before. So that's a little different trend. Now, they, of course, are raising rates because they've got a very big demographic problem. They've got an aging society, and they kept rates low for a long time. But now they're making changes to increase rates to slow things down because the economy is getting a little bit better there.
Yeah. I mean, I think it's, we talked a little bit about it, that kind of surprise rate hike, I think took a lot of people kind of by surprise and, really precipitated the unwinding of a reverse carry trade, which was kind of the beginning of August, that huge volatility spike we saw. But I think some of the news that came out since then too, the market, I think, kind of calmed down. We had, the Bank of Japan's kind of head came out and said that they were going to be cognizant of the global markets, things like that. So it really calmed fears that they would do that, wouldn't do that again, and that would be more telegraphed. But one thing I think that's interesting to look at is Japan's overall consumer prices in July rose 2.8% year over year. So we're starting to see inflation pick up again. And that was always a concern with it is, one of the reasons we don't really factor this in America as much, but one of the reasons they have to raise rates there is to actually help defend their currency, the yen, which has been weak, really historically weak this year so far. And the issue is when their currencies are weak, it's great for exporting, but Japan is an island and they are a big importer. And so goods are more expensive, primarily energy. One of the big drivers behind that 2.8% number was the increase in energy bills. So if we see the yen weaken again, could we see kind of inflation spike there again, and have the Bank of Japan have to take measures again to strengthen the yen by raising interest rates? So an interesting dynamic there, obviously a little different than what's going on in the US, where we're seeing the dollar weaken. We don't really have that issue of having to fend off the dollar for the most part.
Right. Well, it's interesting. We did see the commodities fade a little bit in the work that you described on tally scores, but we did see a big rally in late August on oil.
Yep.
Up
Yeah.
7%. But then other commodities went down, right?
Yeah.
Last of August.
The big driver down, I think, combines a lot of the agriculture, wheat, things like that. We've seen better results. So that's been kind of the driver of those moving downwards. Oil, though, has been a huge rally. We saw a big rally towards the end of August, mostly at tensions in the Middle East. You had Libya threatening to halt the country's production of exports. So that's driving some of that. Although recently, as of this last probably week, we've started to see that oil pull back again. And a lot of that's been the new narrative, really, and that's spreading through the markets right now too, of recession. So once we see recession fears, that's crimp on demand, which usually pushes the price of oil down. So we're really seeing this jostle back and forth. And obviously just with the geopolitical concerns out of the Middle East right now with Israel and Iran, there's a lot of potential there for oil prices to spike back up. Obviously, you also have the tanker that was there was a tanker in the Straits that caught fire. So there's a lot of I think outside circumstances that could really impact the oil markets.
Mhm.
But on top of that, we saw copper actually rise to its highest level in nearly 6 weeks. A lot of this is based off of the Federal Reserve easing, and with that, the U.S. economy growing, as well as some signs. Whenever we see signs that China demand is going to pick up again, they're the big consumer of copper. We usually see that kind of really impact the copper markets. And then the last thing is the zinc is up 15% since August 7th. And most of that's because of supply issues. So 14 large smelters in China actually have gone down. And some of this might be strategic to really drive the price of zinc up. We've seen, I think the 14 large smelter factories, if you will, and they actually said they were shutting down for kind of servicing and production. In reality, that's might not be it. It might just be a ploy, or that might just be the statement to help drive up the price. Obviously, China's been known to be, in some ways, a manipulator of the market. So, but that is impacting, at least in the short term, the price of zinc. So we are seeing, although the overall trend of commodities has been down for the most part, we have seen some examples, copper and zinc, that have kind of defied that trend.
Yeah. So between things going up like tin and copper and then things going down, it's kind of a draw in commodities. So we're getting different movements. So it's really interesting.
Yep, exactly. And I mean, the other thing I'll point out we talked about is precious metals has been another one that's, I think it's taken a break the last week or so, but I mean, it's consolidating after major gains we've seen over the last month and really year to date. I mean, gold has just been one of the top performers year to date. So, commodities overall have been better. As you said, it's been more of an even, kind of balanced out situation.
Yes. So interesting. We'll see how it all plays out. So with all these things happening and all these changes happening, of course, we're in the middle of a political season, and so we have both candidates out there. And of course, President Trump thinks that what he did was the right thing, and the economy was strong, and so he's trying to go back to the way it was when he was in office. So he's coming out with all these proposals of things that will bring the economy back to the way it was before. And then the Democratic candidate, who's the vice president, Harris, she comes out and normally had been very different policies during the Biden administration, but now she's changing her policy proposals to actually copy most of what President Trump is saying. And so there's lots of implications to that if both candidates are saying the same thing. And that's kind of, we'll leave that for the political people. But I will say both candidates are proposing similar ideas. That means that's probably what the public wants to hear. And that's probably maybe the right prescription for the economy. So maybe that's a good thing that both candidates are saying now the same things, although it took a big movement for the Democratic candidate to get there. But now they're both kind of saying the same thing. So that probably means that's where we're going, Chris, on the economy, where they're going to clean up a lot of the things in the economy that weren't working, and clean up the border and all those kind of things that are causing stress on the financial system.
Yeah, I mean, I think that's the hopefulness of it. I know one of the items actually, no federal income tax on tips has been picked up by both sides. I think that's an interesting one just because politics aside, from an economic standpoint, it actually doesn't make as much sense, really. I think it's more, as you said, kind of a play to get some votes maybe here or there, especially in Nevada, which is contested. But from an economic standpoint, usually you have those tax cuts or exempt areas to really try to emphasize and grow a certain part. And tips, I mean, tip culture has just been obviously, I think, rampant in the US. I know we've, I think, talked about it on this podcast, but the other things that people don't realize is, there's ways that either hedge fund managers or other groups could actually, use that loophole to take advantage of it. It's going to be really interesting. It is interesting seeing that, you have one party come and mimicking the other. But whether it's just a pander to kind of get votes and it doesn't take effect or not, remains to be seen.
Yeah, we'll see. We'll see. But it is interesting. This is a very different kind of campaign because usually the campaigns are different sides. So they're both kind of touting a lot of the same things. But food inflation, has been caused by commodity prices, meats and grains rising, and of course, then now they're going down a little bit, and of course, wage increases. And there's been a very aggressive push in the last 4 or 5 years to increase after the pandemic minimum wages. And certainly, there was a lot of stress on the whole system because a lot of people were laid off. But then they not only got their jobs back, they got minimum wages and going up, and the margins are in food are very, very thin. So the proposals that came out about price controls were met with immediate disdain from both sides of the aisle, and so that's kind of gone away. So again, a lot of the proposals are coming together, but it would be interesting to point out though that if you really institute price controls, the most recent example of that, there's been many examples in history, but the most recent example of that was in Venezuela. Venezuela used to be one of the strongest economies in the world, and it was really the leading economy in South America. And then, of course, the Hugo Chavez regime came in and started changing everything, turned it into a dictator state, started controlling the economy, turned the oil industry into a state-owned industry, and they started controlling prices. And of course, it completely destroyed the economic engine of South America. Price and wage controls never work. But that left to misallocation of resources, led to breadlines, led to rationing. People were hungry. People left. Venezuela is the only country with the largest out migration in non-wartime, because they created such an economic mess, and price controls are a big part of it. So pretty much everybody said price controls are not a good thing, and so at least the one candidate that proposed that has gone away from that. So inflation may stay stubbornly high. The recession might be worse than we think. We'll see. But there's a lot of things to be thankful for in this country, and we'll see if the prescription of the Fed is right or if they're making a mistake. I think that the probability is that the Fed is right, but there's always scenarios that no one can predict. And so that could be one other scenario that would play out, that we have hyperinflation after that. So, Chris, let's talk about just interesting things we see out there. Moving on. So I hope everybody got their cheap air tickets on National Cheap Air Day, and that was August 23rd, about a week and a half ago. Domestic flights are down 33%. International flights are down about 10%. That was a nice relief, actually, in pricing. Chris, one other thing that we see out there that's interesting, that's going to increase prices and wages in the National Football League. The National Football League is being invaded by private equity financing, finally. Many other sports leagues have allowed private equity owners to come in, but the NFL would never do that because they wanted one owner, one family control, that kind of control. Now they're starting to allow that. So we'll see prices go up. We may see prices of tickets go up because they're willing to pay more. And so a lot of interesting things happening there. Chris, what else do you have on your list?
Yeah, I think the last thing I have is actually a new lawsuit came out. It's been filed against the largest bank in the U.S., J.P. Morgan Chase, and it's alleging that the bank swept customers' idle cash into accounts that had unreasonably low interest rates. So, as Brian said, I mean, you could have money market funds that were making upwards of 5%, and this lawsuit is now alleging that Chase was just keeping their clients' cash and yielding 0.25%, if even, probably not even, when they were really able to just take that, swap it into money market, and then make that difference, that delta. And so it'll be interesting. This isn't the first bank that this actually lawsuit has been filed against, but it is obviously the largest. So and that has potentially a major impact on the the U.S. consumer. So it'll be interesting to see how that plays out.
Okay, I have two more things, Chris. I saw a report and took a look at this, and this is true, that there were 7 stocks last year that were such great performers in the technology area, and they're not all performing as well this year. but they were called the Magnificent Seven. And this year they were kind of like the Fabulous Four because three weren't doing as well. Anyway, they're so large and so successful in capitalization that seven group of stocks was worth more than all the Chinese stock market, which is amazing, and twice as much as all of Japan and all of Europe. So it's just staggering the amount of wealth the capitalistic system has created. So people who complain about capitalism and they realize is the wealth that's been created, and it's not all among the wealthy. I mean, the middle class and many, many folks have money in 401ks and index funds, and that's all money that is in those kinds of stocks. So everybody's benefiting. It's not just the rich; it's everybody to the extent that they're in. So that's a real big positive, and just wanted to point that out because people complain about capitalism, about how there's a lot of inequities and unfairnesses. But if the index funds own all these Magnificent Seven and they're that powerful and that much impactful compared to worldwide countries, we're all benefiting from it. One other thing I wanted to point out about the economy slowing down is Shake Shack announced closing 6 locations in California, and they cited that $20 minimum wage law. And we talked about that in previous episodes. We're seeing more implications of it. Previously, Pizza Hut ended delivery in the state of California, and they laid off 20,000 delivery drivers. McDonald's and In-N-Out Burger have both raised prices now in a big way. Used to be able to get a Big Mac Happy Meal for under $10. Now they're all $12, $14, $15 for a Big Mac Happy Meal. And they've also reduced staff hours, causing unemployment. So they're reducing hours, and that reduces service. And then they're increasing prices, so that retards, the spending at those stores. So everyone wants people to make more money, but the implications of that minimum wage is being felt in unemployment. And of course, that's what all the models say. If you go to an economics class and they show you the supply demand curve, and prices go up and supply goes down, and all those kinds of things, or actually supply would go up if prices go up. But nonetheless, the implications of that in the real world are showing right now in California for sure, and other places where they raise the minimum wage. So minimum wages do cause unemployment. Now, there may be a reason people want unemployment. I don't know. But it's clear that it's happening, and it is true. And the graphs still hold true, those same concepts. So anyway, Chris, I think we're almost done for the day. I do want to point out on the blog posts of the leadership matrix, we have some very interesting things. And I would say, Chris, this is one of the most consequential blog posts that we've ever had at 4-Star. And I point this out because I've done some studying on this and reading up on this subject tremendously. And it's about the food crisis and the obesity crisis in America. There's a University of Chicago article about our system. And frankly, however America has done a great job in capitalism and other areas and freedom and leading the world, we've done a pretty lousy job in our own food systems in America, to the point that 42% of Americans are obese, yet only in Japan, only 4% of Japanese are obese. So that's really changed dramatically since the 1950s, 1960s, when we were down in those lower level numbers as far as like weight. People were not overweight in grade school. People were not overweight in so many areas of life. And now that's all happening. 40% of youth in schools are overweight as well. So please go on our website and look at that article. It's a very interesting article. Now, of course, there are some weight loss drugs that are out there, Chris, which you've heard about. There's the Ozempic, the Trizepatide, the Mounjaro, and all these different drugs that are suppressing people's eating, so they're losing weight. So that creates some risks, of course, but there's some big positives as well. So I included a link in that blog post to a podcast for the Free Press with Barry Weiss, and she has on there her guest Johan Hari, who wrote a book called The Magic Pill that talks about the benefits and risks of taking Ozempic and other weight loss pills. And their posture that maybe the loss of weight, people who are 20, 30, 50 pounds overweight, losing that weight will help them more so than the risks of taking that drug. So that would be an interesting thing to listen to. Then also there also attached to that same blog post is a interview by Tucker Carlson with Casey and Callie Means, and the lady Casey is a theorist in the medical world, former brain surgeon who left the brain surgery world to find out how to make people safer and healthier. She was serving customers who had brain problems and made them better, but then they were dying of other reasons. And so she wanted to make sure that we could get people healthier by fixing our food systems, our medical systems. Many people think the pharmaceutical industries are designed to keep us sick, to sell us more drugs, and the food industry, sells high fructose corn syrup, a lot of other additives that are killing us and creating obesity in America. So have a look at those. It'll take some time to listen to them, but I think they're probably worth it. So that would be all I have for today. Chris, anything more on your end?
No, I think that about covers it.
Okay. I think that's it for everybody today. Thanks for being with us on this episode. Please enjoy all those blog posts and things we mentioned to you. We'll see what the Fed does, hopefully here in September, and we'll be back probably right after they make their move, and we'll be able to assess what's happened. And so the 4-star Chris, today's Market Explained podcast, or Chris Reardon and the whole 4-star team, over and out for today. We'll be back again very soon. The 4-star podcast. Thank you there.